Hello everyone and welcome to this week's FX Update webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us for this webinar. If you have any questions, and please don't hesitate to ask them along the way. If it's relevant to the topic that we are discussing, then I will of course try and answer them immediately, otherwise I'll save them till the end of the webinar. But most importantly, I will try and address any questions that do come my way. As always, the format of this is going to be a quick fundamental introduction. A quick fundamental introduction, talking about any key topics for markets currently, and also a quick look at the week ahead, because there is plenty to talk about in regards to that. And then we'll look at the charts, see how things are moving, and see how things are developing since last week's webinar. The most notable of which being that Bank of Canada rate hike, which I said I didn't think would happen, happened anyway. So more fool me, I guess. Yeah, we'll just see how things are going. And as always, like I say, please do ask any questions. If there's any currencies that I've not covered that you'd like me to, then feel free to ask. Now, what we've got in front of us right now, for those of you who have not joined us before, is the OANDA Market Pulse website. That's where myself and the other analysts here at OANDA upload all of our analysis and content every day, as you can see on here. It also has access to our economic calendar. Now, you can also subscribe just here, I should say. It also gives access to our economic calendar, which tells you about any upcoming events. So as you can see, for example, right now, Janet Yellen has been testifying for the last hour. That's still happening in front of the Senate Banking Committee. The reason I highlight that is because the charts naturally respond to Janet Yellen. She is the chair of the world's most prominent central bank, the Federal Reserve, and her comments tend to be followed very closely by traders. So if we see the markets moving quite aggressively during this webinar, then it's likely that this will be associated to what Yellen is saying. And we'll try and update as we go, obviously, if there is anything to note. For example, yesterday she did mention about the need to gradually raise interest rates. She also said, and I think this is more important, they are monitoring the inflation, looking for signs of subdued inflation, which is something that's concerned certain policymakers in recent months and could slow the pace of tightening. She also said about the lower neutral rate, which effectively means they don't need to raise interest rates as aggressively as they've had to in the past. So maybe they'll slow down around 2.5% to 3% rather than go up further on. So again, that points to lower longer term rates, but also a slower pace of tightening, which typically would be weaker for the dollar than it would have been in the past. So looking for further signs like this once again today. Now, with the economic calendar, you can always filter it by whichever events you're looking for, because there's always going to be things which aren't relevant to you. We are looking for anything starting tomorrow, taking us up to the following week. So I'll apply that date filter right there. And we're also looking for things that just affect what we're talking about. So I'm going to highlight the currencies which I'm going to be talking about. So things like the Australian dollar, the Canadian dollar, of course, which has been extremely active. Now, we're not talking about the Chinese yuan, but we do have some economic data next week, which I think is going to be relevant. We've got Germany, France, and of course the Euro area. We have Japan, because we're going to be talking about the Japanese yen, the New Zealand, because we're going to be talking about the New Zealand dollar, also the UK for the pound, and of course the US. Which leaves us with this. I'm also going to filter by this. So this is low volatility, medium volatility, and high volatility. I only want to see medium and high volatility events. Now tomorrow we've got a big focus on the US primarily because we've got retail sales and CPI inflation data. Two things to know here. One, retail sales, arguably one of the most important economic releases that we have for the US. The consumer accounts, or should I say, services industry accounts for around, and this number seems to change, around 3/4 of the US economic output. So of course it's very important, and I believe the consumer accounts for around 1/3 to 1/2 of that. So obviously it's a very important part of the US economy. So retail sales is typically a very strong indication as to how strong the economy is, and it's not been great. We have actually seen a slight downward trajectory on average over the last few months, which is a sign that the economy may be cooling and that the consumer isn't seeing the benefit of this tighter labour market, or this supposed tighter labour market, which has been prevalent in the wage growth figures. So this is one to watch for, because this is something that markets tend to be quite reactive to. We've also got the CPI inflation data. Of course, this is half of the Fed's mandate. You've got inflation, or price stability otherwise known as, and maximum employment. Well, it's safe to say they're achieving their mandate of maximum employment, which is thought to be at around 4.7% unemployment currently. It's now 4.4. Yet we're not seeing the inflationary pressures filter through via wages, and the inflation number itself is actually falling short as well. You can see here, CPI year on year, 1.7%. The Fed's mandate is 2%. Core inflation, 1.7% also. The Fed's mandate again is 2%. So we're obviously falling short here, despite the fact that we are in this tightening environment. Now, it is worth noting two things. One, the Fed's preferred measure of inflation is the core PCE price index, not the CPI figure. The other thing to note, though, is the CPI figures typically released around 2 weeks before. So this is our earliest insight into the inflation data for June. So while we know this isn't the Fed's preferred measure, any movement in this you would expect to see roughly replicated in the core PCE. The other notable thing is that the core PCE is actually lower than the CPI reading at this moment in time. So that is suggesting that the Fed is actually further away from its inflation target than the CPI number would suggest. Going into next week, this is we'll start things off with a lot of data from China on Monday. Of course, we've got GDP data for the second quarter. It grew strongly in the first quarter, ahead of the 6.5% target at 6.9%. This was fueled largely by large amounts of fiscal stimulus, infrastructure spending, which is expecting to cool in the second half of the year. So we may get another strong figure again for the second quarter, but we can't expect this to continue for the full year. It was also fueled as well by stronger exports, stronger economic growth globally, which is fueling some good trade figures for China. As we saw this morning, the trade balance figure, we saw a strong trade surplus driven by double-digit imports and exports. So both reflecting the infrastructure side of things, but also the strong external demand for Chinese goods. We've also got things like industrial production and retail sales also as well. So it's likely, or possible at least, that the way the Chinese data performs first thing Monday morning during the Asian hours is likely to influence things like the European Open. We've also got inflation data for the euro area, although I think this is revised data because the little p that you can sometimes see next to these numbers represents preliminary data, so this could be revised data, I think. So that may make it have less impact, but obviously it will be closely watched, especially when we've got the ECB next week, which I'll come to in a second. We've got the RBA minutes for Tuesday. Now, without wanting to put my foot in it once again, the RBA is expected to stay on hold for quite some time still, while certain pieces of data could suggest that it could be primed for potential rate hikes down the road. There is big concerns about things like household debt and house prices and things like that. I know that sounds very similar to Canada, but we haven't heard the same noises from the RBA as of yet in relation to the desire to raise interest rates. So that could change, of course. That's what we're looking for in the minutes. Are there any signs that that's changing and they're looking more towards the Bank of Canada model? We'll have to wait and see, but at the moment that is not expected, and the things that you'll read at the moment suggest that the RBA may be waiting till 2018 or even 2019 to start raising interest rates. The CPI inflation data from the UK will be very closely watched, because the Bank of England has talked about raising interest rates because they want to offset that higher inflation number. Now, the Bank of England has an issue right now. They've got the higher inflation number, but that's been driven by the weaker currency. So inflation is well above target at 2.9%. Even on a core basis, it's at 2.6%. But then it has this dilemma. It's 0.9% above target, and yet the economy is slowing. Growth is lower. Consumer spending is lower. Consumer real incomes are actually in negative territory at the moment because we've got high inflation and low wage growth. There's the Brexit uncertainty hanging over the economy. There's a number of negative drags on the UK economy right now, which is likely to lead to slower growth down the road. And yet you've got certain policymakers pointing towards this inflation data saying it's already higher than what we anticipated, and we therefore may need to raise interest rates, which could act as another drag on the economy in order to offset this. Now, there's a number of reasons why they may be looking to do this. There's a lot of speculation about why they maybe want to do this. Is it a financial stability risk that's actually leading them to want to raise interest rates? Are they wanting to get ahead of the curve, potentially anticipating another recession some point down the road? It's not clear. Is there pressure coming from other central banks or other governments which is pushing for central banks globally to start consider raising rates? Is another theory which, given the fact that we seem to be seeing this coordinated effort suddenly, the ECB wants to taper its asset purchases. The Bank of Canada has just raised interest rates. The Bank of England's talking about raising interest rates. The fact that this all happening in a coordinated fashion suggests there's something more to it than just high inflation, because we've seen them look beyond the high inflation in the past and not raise interest rates. Importantly, though, we are starting to hear more from policymakers within the Bank of England. Mark Carney's made it perfectly clear that he does not support raising interest rates right now because of the way the other economic data is performing. His deputy governor only yesterday, Ben Broadbent, claimed that he doesn't support raising interest rates at the moment. It's the wrong time because of the way the economic data is heading. But there is other people who have suggested otherwise. Andy Haldane, the chief economist at the Bank of England, who voted against raising interest rates, said it wouldn't take much more, and if the economy continues to perform in line with expectations, then he may be persuaded to raise interest rates. And then there's the people, of course, who have already voted. So it's likely to be very close. And if we see more inflationary pressures on Tuesday from the CPI data, you can expect it to get closer and closer again. And I think you'd likely see a lot of reaction in the pound as well. Moving on to Thursday, we've got two big rate decisions. The Bank of Japan, which is expected to be unchanged. Bank of Japan actually going the opposite way to these other major central banks within the G7 at the minute. They have not talked about tightening monetary policy at all. In fact, they actually increased their bond purchases last month because they are not achieving their target that they set out from a monetary policy perspective. That is, they didn't commit to, or they changed their strategy last year. They, rather than commit to a certain amount of bond purchase each month, they said we're going to buy bonds in such a way that the 10-year yield on the Japanese government bond, the JGB, is at around 0%. Well, when yields on UK bonds, German bonds, French bonds, US bonds started rising in the last few weeks in response to this more hawkish rhetoric from these central banks, the Japanese yield started rising a little bit as well, albeit on a much lower scale. Well, the Bank of Japan saw this and increased their bond purchases to suppress that yield once again. So clearly they're headed in the other direction. I'd expect to hear more of this kind of rhetoric from the Bank of Japan on Thursday. The ECB, on the other hand, is facing something altogether different. Their current bond purchase of 60 billion euros per month expires at the end of this year. So they have to announce something in the coming months to go beyond that. They're not going to end it abruptly. That seems extremely unlikely. The chances are, and the speculation is, they're going to announce tapering. Now, for those of you who've listened to me before, you'll know that I already believe that they are tapering, whether they call it that or not. They reduced it from 80 billion to 60 billion in March, and I am very adamant that they did so with the intention of doing further tapering again at the end of the year. Now, they announced the last one in December, so they were a few months ahead, so they lined the markets up. So that would suggest that we're probably going to get an announcement in September about what they plan to do in January with regards to bond purchase, and it's likely that they're probably going to reduce it down to 60 billion with the intention of reducing it more. Maybe they'll put an extension on that of 6 months and then intend to do more again further down the line. But what that means is next week, they may use next week's meeting just to warm the markets up, plant the seed, get people talking about, or at least anticipating the fact that they may be announcing something in September. So again, this could be another volatile event because of that very thing. And that's where the inflation number that we were talking about earlier in the week comes back into play. Retail sales from the UK, again, is another big number, simply because the UK economy is slowing. But as with the US, retail sales is a big part of the UK economy. They've got Canadian inflation data as well, but after that rate hike last week, this week, it's going to potentially be less influential, although markets are pricing in another rate hike now this year. And yet again, I'm not entirely convinced, but then again, I wasn't convinced last week either. Okay, that's enough fundamentals for one webinar. let's take a look through the technicals. I do have a question here, so it was a bit longer, so I couldn't get to it without just pausing during the economic calendar, so apologies for that. Any chance you could explain how prices or indices are likely to move based on certain news, e.g. what would Yellen say to spark a bullish or bearish pattern in the US dollar? So the different markets respond differently to different things. So taking yesterday as an example, what Janet Yellen said was seen as dovish. Dovish meaning they anticipate a slower pace of tightening or slower pace of rate hikes in the foreseeable future. What that did is that because that was more dovish than the markets were expecting, that actually worked to weaken the dollar a little bit. And what that did for US dollar yields, so this is your 10-year US Treasury yields, your 5-year US Treasury yields, your 2-year yields, is it actually lowered them slightly because people are pricing in lower rate hikes, lower interest rates in the future, which meant lower yields on US Treasury debt, which withdraws some of the demand for the US currency because there's less demand for the lower yielding debt. Now what that did is actually increased the desire for US stocks and stocks elsewhere, simply because the yield on US stocks suddenly looks more attractive compared to the lower yielding debt. And these are the type of short-term responses which you can get. So Janet Yellen said something dovish. We saw yields on US Treasuries drop, or US Treasury prices actually rise because they move inversely. We saw the dollar weaken slightly, and then we saw equity markets rise, and that's the type of thing we can see. It's all about interest rates. If something, data, comments, whatever, suggests that we're going to see higher interest rates in the near term, then that tends to be bullish for the currency. If we expect lower interest rates in the near term, then that will be bearish for the currency. Now, lower doesn't mean reduced. It can mean that we were pricing in 2% in a year's time, and now we're pricing in 1.75%. So that would be bearish for the, typically bearish for the currency. I hope that answers your question. Moving on to the charts next. Euro dollar, we're still seeing it struggle around those kind of 114.50, 115 marks. We've entered into this kind of rising channel once again. It seems like momentum is looking to fall out of the move. We did break briefly above that resistance level, which I've highlighted on previous videos here, but then we did push immediately back below. The thing that concerns me here a little is the momentum indicators. We've got the stochastic, which is made a lower high when prices made a higher high. We've seen a flattening in the moving averages on the MACD, but the MACD histogram as a result has moved lower. That kind of divergence is a bit of a bearish signal. It's not a sell signal per se, but it can be a bearish signal and something therefore to watch out for. That doesn't mean that we won't see moves higher, but if we see a move below this rising channel, then that could be a bearish signal, with the emphasis then being on these kind of 113s, and a break of that could be bearish again because that would be taking out this series of highs. But that doesn't mean again that we can't grind higher in the meantime. As long as we stay in this flag, then we could continue to make these higher levels. Cable is pushing higher once again. Now we have seen a lot of volatility in the last 48 hours. We had this kind of consolidation pattern. We came back towards this previous resistance level. It was a zone that I'd actually highlighted on the way up as well, which we didn't get too much response from, but you could see for quite a while this zone has been a notable level of support and resistance. It wasn't the last time of asking, but it has been once again now. So we've rebounded off this level. We haven't closed outside of the falling channel just yet, but we have traveled back through, and it looks like we have potentially broken above. That could be a signal that we're going to see a move back towards that 130, but 130 has continued to be, or just above has continued to be, a strong zone of resistance for quite some time. One thing I haven't looked at is whether it was actually a fib level, or one thing I haven't put on my chart, should I say, and it was a 50 fib level as well. Look at that perfect 50% Fibonacci retracement as well to note there, but that's done, so I can remove that from the chart now. I think it's interesting as well, we do have this clear zone. We've got the short term range, which is 128, 130, and we've got the longer term range, which is 126, 130. That still seems very much in play, and until we see a break either side, I see no reason to think that that's going to change at this moment in time. Of course, though, I am just paying attention to the charts, and should that change, then my belief will change along with it. Euro sterling also seems to be stalling at these higher levels. We did finally break through this resistance level, which we'd seen had provided resistance on the way up a couple of times, around 88.50 through 88.75, prior support and resistance. We did finally break above, but we didn't hold above here but for long. We got to around 89.50 before pulling lower. Again, the momentum just doesn't seem to be overly with this move at the moment, but really the confirmation of that will come from a break below this rising channel. Break below here, for me, brings this kind of 86.50, 86.75 into focus. Here we've got that previous zone of support and resistance, and we've also got the confluence of moving averages there. That's the 55.89 band, which I use on my charts, and also the 202.33 band. Most of those numbers you will recognize as being fib numbers, something that I'm just personally a fan of. Everyone has their own preferences. Again, that's not to say that this can't continue to grind high. We could move all the way back up to 90 on lower momentum. That could potentially happen, which is why I'm looking for a break of this rising channel to give me some form of confirmation. Preferably, I'd also like to see a break of this level here around 87.50, prior resistance and most recent support as well if you want further confirmation. Aussie dollar is trading at its upper extremes at the minute, so I think that's something which we want to be fully aware of. We had these possible temporary resistance levels along the way. We didn't really respect these, if I'm perfectly honest, but they were a thin line for a reason. They were only potential temporary resistance levels. Here's the big one, which is where we're at right now, around 77.50. You can see 1, 2, 3, 4, 5, half a dozen occasions over the course of the last year when this has proven to be a major zone of resistance. Clearly, traders are wary of it because we hit this level earlier on today and immediately we saw some profit taking. Now we've got 3 strong candles here, so there could be a bigger fight on the go around these on these levels. But again, let's wait and see. The first sign is that we've seen some profit taken. We may see another assault, but just take into consideration how big a resistance level this is. I wouldn't be surprised if we do see another correction off the back of this. But really, things are looking quite bullish in the Aussie dollar pair at this moment in time. The test will come really much further down. So if we do see a rotation lower, then really you want to see a break of 75.75 before you start to becoming anyway bearish on this, because that's the most recent low, given the strength of this recent rally. Do I ever overlay PSARs on price action? I assume you mean parabolic SAR. I don't. I have in the past. I've tinkered with it. Parabolic SAR, by the way, stands for stop and reverse. They are the 3 dots, which I can actually show you, I believe. Let me have a look. Insert indicator. So you can search for all your indicators here. So you can add it here. So this is a parabolic SAR, and the most basic way in which this works is you're looking for 3 dots in a row to indicate a trend reversal change. So say, for example, here you're looking for a buying opportunity, then in its most basic form, then 3 spots in a row is meant to signal a potential trend change. Now you wouldn't just use this on its own, you'd use it with other indicators, but that is like the textbook explanation or of one way in which these parabolic SARs can be used. The parabolic SARs, they are useful. Again, I think most indicators are useful if used in conjunction with other technical analysis tools. It's not something I use on my charts myself, but again, you are limited by how much you can use. You can't have everything on there. You can't just overload your charts with everything. You can get kind of analysis paralysis by just using too many tools at one time. I've found a set of indicators which works for me, and I've seen no reason to doubt parabolic SARs. It's just not one of my personal preferred indicators. Do I think it would be a smart idea to sell when the stochastics cross over, leaving the overbought zone? And can you add audible sounds for indicators? First and foremost, I must stress, as per the disclaimer at the start, I can't give advice on when to buy and sell, or when is a smart time to buy or sell. That's just not what we do here. What I would say is for example, with the stochastic, when the lines cross, so for example, taking this point here, when the lines cross out of overbought territory and the lines cross each other, that is seen as a bearish trigger, a bearish signal, as you saw here, which followed with some downward, a downward move in the in price action. The same could be said here. We saw the cross here, and then moved out of oversold territory, and then this was followed by a higher move. It doesn't work every time, but as I said with the last one, I wouldn't just use one indicator on its own to give me a buy or sell signal. So while this can be used to support your analysis, I think price action is always king, and I think it should be used with other forms of analysis. And again, you can always find your own format, your own formula, which works for you. Breaking a fib from top to bottom. Alan, if you could ask that question again, I'm not entirely sure what you mean with regards to your fib question. So yeah, so Aussie dollar, it looks like it's at its upper extremes right now. Momentum does seem to be lacking a bit, which isn't surprising given the levels that we are trading at. It doesn't suggest that we're not going to break through here, because what we could see is a break of these levels, a number of stop losses being triggered just above, which could trigger quite a strong move higher, and then all of a sudden momentum comes back with the move. But we've also got this previous high right here. So again, we have got this kind of confluence of resistance levels, which is going to make life tough for the Aussie bulls at this level. Will this webinar be available later? Yes, it will. We are recording this webinar as I talk. It will be added to YouTube, our YouTube channel, in about an hour's time. It will also be added to the OANDA Market Pulse website, which I showed you at the start. That's marketpulse.com. And if you look in the video section, you'll be able to find it there, as well as all our past webinars and videos. And you'll also be able to find the other video which one of my colleagues this week did, called Jeff Halley in Singapore. He did a commodities video, so he talked about any commodity that you could possibly think about, pretty much, and that was a very good video, so I recommend you watch this one also. Right, I think I'll come back to these next ones at the end, because there seems to be a lot of indicator questions, and I don't want to just stop on the individual charts, so I will come back to these questions at the end, because there is quite a lot coming through. Dollar CAD, of course, has been very bearish because of this anticipated rate hike, which I would seem to be the only one who thought. Well, actually, let me reverse that. I wasn't the only one that thought that they were going to raise rates. Markets had actually priced in at around 95% this time last week, but there was a lot of people doubting whether it was going to happen. There was a number of banks doubting whether it was going to happen. Around 5 out of 8 economists thought it was going to happen, so they clearly weren't in agreement about it happening at that moment in time. The markets seemed absolutely convinced, which in my eyes left it vulnerable to possible corrections. Now, we didn't get that on this occasion. Instead, we got the rate hike, and we saw another bout of selling yesterday. That bout of selling took us straight through these possible support zones, but that's what fundamental news does. But we did hang up around this prior low. We have seen some initial profit taking. It's way down a little bit now, but I will be intrigued to see whether we can break these lows, because for me, a breaking of these lows would suggest people are anticipating another rate hike. A failure to make a new low, so if we're looking at the 4-hour chart, for example, a failure to make a new low and then a push high possibly suggests this could be a one and done type scenario, and that we could be due a correction. And looking at this from a technical perspective, that is one aggressive sell-off, so a correction wouldn't be the end of the world, especially now that the Bank of Canada has acted. And in terms of possible resistance levels on the way up, I see no better one than this 130 level. It's a key psychological level, it's a big round number, and most importantly, it's been a big level of support for some time. It wouldn't even surprise me if it also fell around a key fib level like the 50% Fibonacci retracement level, for example. Now, I'm a bit premature here because we don't even know if this is the ultimate low yet, but should we stay above this low, make a new higher low and move higher, then I think that's going to be a massive level for me. Big test of just how bearish people are in the longer term. New Zealand dollar, US dollar, like with the Aussie dollar, we are at these upper extremes right now. We do have one higher high to come, but you can see on 3 occasions we've hit these levels and rotated lower. We've hit this level once again, and we've seen some profit taking. Again, no surprise, we've got the rising channel, which signifies slowing momentum. We've got the stochastic lower highs while we're making higher highs. MACD lower highs on the moving averages, and the also the histogram as we're getting higher highs on price. This is negative divergence, typically a sign that the market's exhausting. Not confirmation though, because that can happen for a while and then can change even though prices are moving higher. But again, should we see a breakthrough these kind of 72s, breaking through this rising channel support, breaking through the previous lows, then I think 71.40, this kind of level will come into sight, or even 71 from this confluence of moving averages, potentially signifying at least a temporary correction. I'll finish with the 3 yen pairs, and then I'll wrap things up with a couple of questions and then get off, because I don't want to hold you too late. We've already overrun, but of course this seems to have been a very popular webinar this week. A lot of attendees, so thank you very much for joining. I really do appreciate it, and I do hope you've got a lot from it. And also a lot of questions, which I always welcome. That is the point of these webinars, by the way, compared to videos, is the your interaction. Dollar yen, we hit these 114.40s, which is this prior area of resistance that we noted last time. We've seen a bit of profit taken off there. That's not my primary resistance level though. It's here, because we can see this one hit on a number of occasions. I really want to see these kind of 115.50s being tested, and I think it's possible, particularly given that we've come back to the 112.80s after this kind of profit taking, and it looks like we've seen a little bit of buying appetite. At the moment we're only seeing a little bit, so there's nothing is nailed on per se, and we have got that kind of lacking momentum from the stochastic, not really being confirmed from the MACD per se, but we are seeing a little bit of a rotation higher, and I wonder if we're going to see another challenge of these 114.40s, potentially a challenge of these 115.50s. If not, then if we see another rotation lower, then it's this kind of level I'll be looking at next, around the 111.80s. We've got the confluence of the moving averages here. That's the 200, the 55, the 89. It's also prior support here, and it's prior resistance here. So that's the level which I'll be keeping an eye on very closely should we see another rotation lower. And it's also roughly in line with the 50 fib, just to cap things off there. Sterling yen is the penultimate chart. We broke through this possible area of resistance, which again was just a popular zone in the past, going back to June of last year. We broke through there quite easily, but now we're testing on the downside, and it looks like we've found some support, not coincidentally, having run into resistance just shy of these kind of levels here. I think we are going to see potentially another test of these previous highs. A high from, should probably add that level on just here, and then of course now we've got this kind of confluence of resistance around 147.75 through 148.50. A breakthrough here, and things are looking very bullish indeed. Now you have got some possible temporary support along on the way up, maybe around these kind of 151.60s, possibly around these 153.80s, because it was support back here, and a little bit higher again, maybe around the 154.50s. But really, you've got to remember, last time we had these we were at these levels, we had a big sell-off, big buying, and a massive sell-off once again. So you've got this big gap here, and of course this is June last year, this is Brexit, but it means you've got this big gap and there's no solid obvious resistance here. So there could, well, I'm not saying that we're going to then break it. If we break above here, we'll go straight up here. I think it's going to take quite a bullish move to break through these levels, and if we do, then that bullish sentiment could drive this much higher. I guess we'll have to wait and see whether that materializes. The momentum is clearly with the bulls right now, because we've got these long series of higher lows. We've got this flat top. That's a rising triangle. A rising triangle is typically bullish. Wrap things up with euro yen. Euro yen, of course, has been very bullish, and for some time we had this mild consolidation here. We broke through the 125.50s. We broke through the 128s as if they weren't even there. That was prior resistance, but now we are finding some support on them, it would appear. If we do find support on here and rotate higher, then of course the previous highs is going to be notable, but also maybe these kind of 132.40s. It just does seem so bullish at the moment, and again the momentum very much with the rally. So I'm seeing little reason to doubt it right now. So again, I think this is just still now looking quite bullish. If we do see a break below these kind of 128, then we could come back towards that prior zone of resistance. I just don't necessarily see it right now, just because what all my indicators are saying is this is very bullish. And the fact that we've seen it rotate higher so quickly here is just another bullish signal for me. So that does it with the analysis. Just to go back towards these questions. So from Alan, can you add an audible sound when the fib is broken? I don't believe you can, not that I'm aware of anyway, but if you've got any suggestions, then please do send them through, because we're always looking to improve our charting package. Anyone who wants to contact me regarding today's webinar, by the way, you can contact me on Twitter. That's Craig_Forex, and I'm happy to answer any questions that you do have. Or RSI, again, the same applies. When drawing the line for a fib retracement, do you draw the line across the tops or the bottoms of the candle? I use the ultimate lows and the ultimate highs, and I always think the more clear the ultimate low and high is, the better that it's going, the better that it's likely to be. So this Euro Yen chart, unfortunately, isn't a very good example. But if this now moves lower, back towards these levels, then you could draw a fib here, for example, from here to here. Let's see if there's a possible rotation point higher, with a 61.8% fib in this occasion lining up nicely with price support and resistance. That's what I always look for. I don't just want to see a fib level, I want to see how it coincides with everything else. Should we break lower again, then the next lower dues would be here, but I'm using the ultimate low point of a candle and the ultimate high point, so that's the top and bottom of the wick. And in fact, I think I'll leave that on there because it does seem to look quite nice. In terms of stochastic indicator, what does the number on the top represent? 1413. They're just the parameters for that particular indicator. You can change the parameters to suit you. You can make it a faster moving momentum indicator, which means you get more signals, so it goes into this in and out of the upper and lower extremes more frequently. You get more crosses, or you can make it a slower indicator, which is kind of what the RSI is in a way, so you get less signals, but they're deemed to be more reliable, although no indicator is fully reliable. And I think that's it. That's all the questions. Perfect. Thank you everyone for joining us. I hope you did get as much from this as possible. Please do join us again next week, same time, for another webinar. Any questions, like I say, you can contact me on Twitter. That's Craig_Forex. And apart from that, I hope you enjoy the rest of your week. I hope you enjoy your weekend, and I wish you all the best with your trading in the week ahead.